Hello, everyone. My name is John Bowen, and I'm the Vice President of Sales with Depreciation Protection, Inc. Thank you for taking time out of your busy schedule and allowing me the opportunity to explain to you how we are revolutionizing the market for total loss. As you know, historically, the only product that we've offered at loan closing has been guaranteed asset protection, otherwise known as GAP. And while GAP is and will continue to be a fabulous and much needed product offer, it's important to remember the gap is only designed to protect against negative equity, leaving any down payment, trade in equity, principal payments highly vulnerable to the effects of depreciation. With the addition of depreciation protection to your loan portfolio, you will have the ability to protect those borrowers with substantial positive equity who will see very little to no benefit at all from purchasing gap, while at the same time increasing your all important non interest revenue. So, before I dive into how depreciation protection works and why it's needed, I'd like to start by discussing uh, what we're seeing today in the total loss market. First, it's important we overcome a common misconception of what a total loss looks like. Now, historically, the image on your left was an accurate depiction of a total loss. But in reality, what you're seeing now on the right side of your screen is a more common total loss. Now, that may surprise many of you. And there are a number of factors at play there, and we've listed a few on your screen now. First, really, it goes without saying, we all know that accidents are on the rise, and we attribute that largely to distracted driving. Now, to complicate matters, according to Black Book, we're seeing that the average annual depreciation rate has hit 17%, and that's both on new and used vehicles. Also, to consider that as these new vehicles hit the market and the sophistication grows and improves, the cost to repair and replace certain components has drastically increased. So, those two factors alone play a huge role in why we're seeing nearly one out of every five car accidents being deemed a total loss. Now, again, we also have to consider that the price of newer vehicles has gone up and continues to go up, which is forcing borrowers to finance longer in order to afford the monthly payment. So the truth of the matter is this: loans cannot amortize fast enough to keep up with the rapid rate of depreciation. So prior to depreciation protection, we as an industry adopted somewhat of a shotgun approach, and we offered gap on nearly all of our car loans. But what we're proving in the market today is that there's no one size that fits all. Now, while the majority of your borrowers are going to finance 100% LTV or possibly higher, we are seeing that a significant portion of your borrowers today have good, substantial equity on the day of loan closing. So what we've done and we've brought to the market is a product that you can offer to your borrowers, again, who need protection of that upfront equity, and you're giving them an alternative to purchasing guaranteed asset protection. And it's similar to how you would offer checking accounts and extended warranties, providing borrowers with different options that best fits his or her need. So to make the case for depreciation protection, let's take a look at a commonly used visual gap tool. And what we're doing here is we're going to track the amortization of the loan, which is represented by the red line, and we're going to compare that to the residual value of the vehicle, represented by the gray line. And we've taken a 2019 Ford F-150 at 90% LTV. We wanted to look at the equity situation over the course of time. And as you guys can see on your screen now, it doesn't take long for that gray line to dip below the red line, creating the negative equity that's represented in the pink shaded area. So to look at this in terms of numbers, we can see again today, there's positive equity of $5,410, but it doesn't take long for that positive equity to dwindle away. So that really by month 9, we project this borrower is going to be upside down. Now, while gap will serve a great benefit for this borrower, again, it's important to remember that if gap pays, it means the down payment or any initial equity plus payments made up to this point in time have been wiped away due to the effects of depreciation. So what we've done is instead of just offering one product of total loss protection, again, which is your traditional gap, we've offered a second option, an alternative, targeting those borrowers, again, who will see very little to no benefit at all from purchasing gap. And we're going to protect the equity today plus future payments. We're going to dive into the math and how this actually works in a few minutes. But I want to point out two things on this illustration. First, you'll notice that gap really doesn't come into play until somewhere between month 6 and month 12. Whereas option number 2, depreciation protection, offers an initial benefit day 1 of the loan. And you'll also notice that depreciation protection provides a benefit over the full term of the loan. Whereas gap, even though may technically say has full term coverage, really we know that in most cases, at some point in time, primary insurance will pay the loan in full, meaning there is no benefit at all from having gap. So quickly about us, again, before we dive into the details, our home office is located between Dayton and Cincinnati. We have extensive experience on our executive management team, over 150 years working in the financial institution space. And we developed depreciation protection solely with the consumer in mind. Again, we were looking to go where gap could not, gap being a phenomenal product, but recognizing that gap does have its limitations. We have over 225 financial institutions across the country offering depreciation protection today. We'd love for you to join that team. And then we are backed by Securian Financial. Securian is located in St. Paul, Minnesota. They are an A-rated carrier who pays all of our claims. So as many of you know, the regulatory environment and regulators have started to become more stringent and more critical of the practice of selling ancillary products, which not necessarily a bad thing. However, it does, we recognize, it does open the door for significant fines and penalties inflicted upon the financial institution for any errors made in the sale process. Now, the state of Texas was first really to jump on board back in 2018. And they focused in mostly on dealerships. However, they did bring in some lenders. And they recognized that gap was being sold on low LTV scenarios, whereas the lender and the dealership were making a good deal of money while the borrowers were seeing very little or no benefit at all. And they started handing out fines for what they deemed to be predatory lending practices. Quickly, the CFPB followed suit in 2019 in their supervisory highlights, and they focused in again on gap and the practice of selling gap on low LTV circumstances. And we know at some point in time that's going to trickle down. Even though the CFPB is regulating the really large financial institutions, we know eventually that's going to have an effect on the smaller credit unions, community banks, things of that nature. So really the point being, it's important that we're diversifying our total loss protection portfolio and putting borrowers in the products that best serve his or her need. So borrowers at 100% LTV or greater, gap is a great product. Gap should be offered. But for those borrowers with significant equity up front, gap's going to serve very little benefit. We now have an alternative in depreciation protection that's going to most importantly protect your borrower. But again, as I mentioned earlier, will increase the opportunity for your non-interest revenue. So let's dive into how depreciation protection works. And the goal of depreciation protection is to protect today's equity and tomorrow's payments. So in order for us to do just that, we will base all of our settlements on the value of the vehicle at the time the plane is purchased. And we refer to that as the locked-in value. So on the illustration, you'll notice that this $33,500 never changes over the course of time. So let's use Mr. Smith as an example. Mr. Smith's at a dealership and he purchases this vehicle for $33,500. He has a down payment of $3,700. So he walks away with an outstanding loan balance of $29,800. The minute Mr. Smith drives off the lot and purchases depreciation protection, we will protect that initial equity of $3,700. So as you guys know, to calculate equity, you take the value of the vehicle and you subtract out the outstanding loan balance. So with depreciation protection, as Mr. Smith makes payments, the loan balance falls, our benefit grows. And we allow that benefit to grow up to the maximum plan of $10,000. Now, conceivably, we could develop depreciation protection or design depreciation protection to pay $20,000, $30,000 in claims. But the reality is, if we pay claims that high, it would drive the cost up, which would make the product no longer attractive or affordable for the borrower. What we've done by capping our benefit at $10,000 is we've made the product very comparable in price to what you're selling Gap for these days. So before I look into year five, let's talk a bit on how the benefit is applied. So it's important to remember that depreciation protection is a debt cancellation product, meaning we pay the debt directly. So think of it how your credit life and your standard credit disability plans are adjudicated, where the carrier pays the loan directly instead of paying the borrower. That's how depreciation protection works. So year three, Mr. Smith gets into an accident, files the claim through his credit union or his bank, and we send the check directly to the financial institution based on our calculation. So the math in this case is very, very simple. We take the locked in value, we subtract out the outstanding loan balance, recognizing that we can never pay more than our max plan. So it's very evident what Mr. Smith is going to receive, a check for $10,000. We send the check to the financial institution. So now instead of owing $15,565, Mr. Smith now owes $5,565. But it's important to remember what hasn't happened yet. Primary insurance is not paid. Because we've paid the loan balance down by $10,000, we are freeing up the vast majority of those insurance proceeds that, without depreciation protection, would be applied solely to the outstanding loan balance, leaving very little or possibly nothing at all for the borrower to use for the next down payment on his vehicle. So let's look at year five now. Now, again, as I mentioned, depreciation protection is a debt cancellation product. So somewhere between year three and year five, this borrower falls, or the loan balance falls to $9,999. Because it's a debt cancellation product, we can never pay more than what Mr. Smith owes on the loan. So when that balance falls below our max benefit of $10,000, we will actually pay the loan in full. So depreciation protection, again, our goal is to pay down the loan or pay off the loan, freeing up all or the majority of the primary insurance settlement to be released in cash to the borrower. Now, we like to believe that Mr. Smith would use the money to apply to his next car loan, but in reality, he can use the funds as he sees fit. No restrictions whatsoever. So as you adopt, or when you adopt depreciation protection, we hope that you do, I think eventually you will find, because the math is so simple and so transparent, it will be easier to explain to your borrower than possibly Gap even today. And the reason is, again, remember, with depreciation protection, there are two factors at play: the locked in value and the outstanding loan balance on the day of loss. Whereas with Gap, there are a number of variables that we have to consider that will affect the Gap settlement. So let's take a look at a couple hypothetical scenarios, and then I'm going to actually show you a real life claim from one of our Michigan partners. This is an 85% LTV on a 2018 Dodge Durango. And today we see that the value of that Durango is $40,000, outstanding loan balance 34, meaning today's positive equity is $6,000. Now, what we've done is we've laid the projected Gap benefit alongside the depreciation protection benefit, because we understand that most of your borrowers today are used to purchasing Gap and may even ask for Gap. And what we can illustrate using the tools that we have at your disposal, we can show the borrower why Gap would not necessarily be a smart buy, but we can protect the equity established today, whether it be a down payment or a trade-in, possibly even a rebate. We will protect that positive equity plus future payments. So when you lay them side by side, it really becomes somewhat of a no-brainer as to which product is the better fit for this borrower. Let's look at a second example. This is an 80% LTV. This is right in the wheelhouse of depreciation protection. We show this on a 2014 Ford Mustang. And the reason we use the 2014 is we're proving that, listen, even the used vehicles are losing value rapidly these days. And again, 80%, meaning the value of the Mustang, $21,800, loan amount $17,440. Today, we will protect $4,360 of that positive equity. And as the member makes, or the consumer makes payments, our benefit grows. Remember, locked in value, which is represented in that second column, minus outstanding loan balance equals the depreciation protection benefit. And it grows up to our max plan of $10,000. And then between month 24 and month 30, that loan balance falls to $9,999. And when that happens, the depreciation protection benefit matches the loan balance dollar for dollar, meaning we will pay the loan in full. So those, again, were hypotheticals. Let's look at an actual claim that came through, a very successful claim that we were happy to adjudicate. And this was on a 2019 Hyundai Sonata. The value of this Sonata was $34,430. I'm sorry, this is Santa Fe. I apologize. $34,435. The loan balance, $26,991. So right now we have over $7,400 in positive equity day one of the loan. Just 3 months later, this borrower got into an accident. And at the time, the loan balance had only fallen by roughly $300. Maybe they only made one payment. So what we did, we came in, our settlement was very quick. We turned this claim around actually in 48 hours because, again, the math is very simple. We verified that value of $34,435, and then we verified the outstanding loan balance on the day of loss. So our math was simply this: locked in value minus outstanding loan balance on the day of total loss equals the depreciation protection benefit of $7,738. We sent the check to the credit union to be applied to the outstanding loan balance. Now this borrower only owed $18,959. A month later, Progressive came in with their settlement of $28,904. Because we had paid that loan balance down by $7,700, he was able to walk away with $9,945 in cash. Without depreciation protection, it's important to note, this borrower would have lost over $5,000 of equity because Progressive settled for so low. So because we paid down that loan, he was able to walk away actually with more money than what he invested in the vehicle, $9,945. So a great success story, and we have a number of these we'd be happy to share with you. We do track these, and claims examples are a very powerful tool when explaining this product to your borrowers. So let's now take a quick peek at pricing and the different options we have available. But before we talk on pricing, I want to kind of share with you what our average claim is, and that's $4,146. The reason I share this with you is because we like to compare that to the average gap claim, which again, nationwide is roughly $2,500. So we're close at paying almost twice of the average gap claim. And that's significant because we do have to price depreciation protection just a bit higher than gap. But we do feel that we've kept it very comparable, which price should not be as big of an obstacle than if we were to increase that max benefit, as I mentioned before, from $10,000 maybe up to $20,000. So our wholesale price will start as low as $225 based on the different options we have available. And we do allow you to mark it up however you see fit. Most common markups are between $200 and $400, but you can make less than that if you choose to offer it cheaper to your borrower, or you can choose to make more, all right? But we do leave that up to you to make that decision. Now, we do have two options. Now, the first is going to be our term-based, and we offer this because we wanted to offer a cheaper product than what our full-term product looks like. And we have three different options there. We have a 12-month that's only going to cover $2,500. So it's a little bit of a less benefit, but we can afford to offer it cheaper, and that's the $225. We also have a 24-month benefit that pays out to $5,000, and then a 36-month benefit that'll pay up to our max of 10,000. Now, it's important to note, if you look at that second to last bullet point, if you are located in one of these states, the term-based option is not available because it has not been filed yet with the Department of Insurance. Now, we do also have a full term, which is our more common or more popular product, and it was reflective in the illustrations I've already shared with you. Now, with that full term, it comes with a 60-day refundable free look period. We do have a fully refundable where it would be prorated after the 60-day free look period. We can discuss that. We'd be happy to discuss that with you if you are interested. But with the full term products, we do break it down by tier. So we have our first tier, which goes up to $25,000 in value, and then we can offer it all the way up to $100,000 vehicles. So naturally, because the vehicles are more expensive, it will lead to potentially higher claims. So we do have to charge a bit more for that. But you'll notice too that we have a $10,000 benefit as well as a $5,000 benefit. So let's touch on the highlights real quick. Again, to kind of wrap everything up in terms of what depreciation protection can offer. Again, we cover all forms of total loss. So collision, comprehensive, we do theft and non-recovered. Basically, the only total loss we won't protect is in the event of fraud. We do offer you the ability to offer this at any point in time after the loan closes. However, there are stipulations in place there. We want to make sure we run a fresh value. We would be happy to talk to that again in more detail when we train your staff. As I mentioned, we do have a 60-day free look period on all of the products we offer. We don't have any mileage or year restriction on the vehicle. However, I do want to point out that we are available on cars, trucks, and vans only. We are not available on your power sports, your motorcycles, things like that. As of yet, that possibly could come in the future. But right now, cars, trucks, and vans only. And then again, as I touched on, this is a different avenue for added revenue from your non-interest income, being able to offer a product, an alternative to GAAP. And then we do have a $1,000 accidental death benefit. We kind of refer to that as our cherry on top. So who are we targeting and how are we delivering it? So our average or our ideal candidate is going to have at least 10% positive equity. All right. So 90% LTV, we consider that to be an ideal depreciation protection loan. Now, what we can discuss if you were to offer it, you can choose your own threshold. If you feel like you need to offer GAAP above 80% LTV, that's certainly up to you. It is a customizable plan. We just suggest starting depreciation protection at 90% LTV and going lower, okay? We do want to pay attention to the refinances, those who've been paying for a significant period of time and have paid down the principal balance aggressively. Also the rebates, again, positive equity is positive equity. We don't limit that as down payments or trade-ins. We're looking at rebates as well. We can protect those rebates that manufacturers are offering. And then also too, looking at your lower credit borrowers, those borrowers who you may require to put money down because their credit is a bit challenged. Those borrowers could benefit greatly from depreciation protection. And then we are available on the indirect and the direct market. A couple case studies to show with you one of the common concerns that we have heard from financial institutions is that depreciation protection is going to cannibalize their already successful GAAP program. And what we have found with nearly all of our financial institutions is by adding depreciation protection, we're actually seeing a growth in GAAP sales. And the reason I think we're seeing that is because it's getting the loan officers more excited to talk about total loss protection, whereas a lot of loan officers may have made the decision to not even discuss GAAP based on a lower LTV scenario. Now they have the ability to talk more options, which I do believe is increasing the average sales for this particular financial institution. Also, too, in terms of increasing revenue, we can see that by adding depreciation protection, we've increased the total penetration up to 65% of borrowers in this particular case study are now protected through some form of total loss protection, which has drastically increased the revenue for this particular financial institution. In terms of sales platforms, we are fully integrated into the most popular, most well-known LOSs, again, that are used across the country. The most common that we've seen is the Allied Solutions IQQ sales system. And this is just an idea of how most of the LOSs will look, but we have made it simple and we have integrated through a lot of different APIs. Whereas we will ask the LOS to do an LTV calculation based on the preferred LTV threshold. So in our example of 90% LTV, we will have the system generate which product works best, whether it be gap or depreciation protection. And again, by plugging in the numbers, the loan amount, the value of the vehicle, it will suggest, again, which product is the better fit for the borrower. Lastly, we are currently developing, very close to rolling this out, a post-close marketing campaign that you will be able to take advantage of. And I provided a few screenshots as to what that will look like. It's important to know, why the post-close market is attractive to a lot of financial institutions. And that's because we understand that the majority of borrowers today are financing at the dealership through an indirect channel. And those indirect borrowers, you don't have the ability to sell the ancillary products like gap, depreciation protection, extended warranty. With the post-close option, you're now able to target those borrowers, offer these protection plans, whereas again, they would not have had the opportunity to buy if they purchased the vehicle and financed the vehicle directly at the dealership. Here's a little bit of what it's going to look like. Again, it's dual branded. We will place your logo and have you fully drive. You would provide us with a loan file that you would like for those borrowers you would like us to target. We will send out an email to those borrowers, allow them to purchase the plan through credit card. Again, we are integrated in with DocuSign and DocuSign payment. We do have a calculation tool available to allow the borrower to see their own benefit and calculate their own benefit to see, again, how the product works and again, how it will benefit in the event of total loss. And we do make it as seamless and as few mouse clicks as possible to enhance the customer experience. And again, as I mentioned, we are fully integrated within DocuSign and DocuSign payments for a secure checkout for your borrowers. So I do appreciate your time today. If you're interested in learning more, we would love to talk to you. Please check out our website, depreciationprotection.com. There are a number of different FAQs that will be beneficial for you, as well as, again, that customizable calculator tool that will help you further understand how depreciation protection works. Also, feel free to reach out to us by phone or through our info box. Again, we would be more than happy to discuss with depreciation protection. We do sincerely appreciate your time today. Thank you very much.